Steps involved include an advertisement being placed usually in newspapers. This advertisement may disclose where the application forms may be obtained from. So this is normally followed by what they call a prospectus. A prospectus is a document that contains all the relevant information about the company, and this information must be read by the prospective investor in order for that investor to get interested in the company based on the way he sees things happening, because this prospectus is an advert. It's an advert itself. So step 2 is on receipt of the applications, the directors go through them and decide which ones to be approved. Then approved applicants are sent allotment letters. Yes, they are called allotment letters. They invite those prospective investors or shareholders. When allotment letters are received, share certificates are issued. And then after share certificates are issued, because a share certificate, once you buy shares from a given company, then they should give you a share certificate, because it is the only one that shows, that signifies, that evidences that you have gotten contract, you've entered into agreement with a given company. Otherwise, if they don't give you a share certificate, you'll appear like you never received anything. You don't have anything like contribution to a given company, and therefore you don't deserve anything in return. So we have the applicants becoming shareholders after all that nonsense. And then the shareholders are asked to pay the balance of share value in 2 or 3 calls when the company needs more cash. So the shareholders if those shareholders who fail to pay the calls, their shares are forfeited or cancelled and loses the money they might have paid already. So that's why it is important to enter into joint stock companies when you are ready to support them when they need your support. The cancelled shares are later relocated by the company. So let us talk about the 4 differences between public limited companies and the public corporations, because we once talked about public corporations, and now we want to compare the distinction between the public companies, public limited companies, and the public corporations. Let us talk about them in terms of ownership. Remember, public limited companies are owned by shareholders, individual members who raise their own capital to start operating a business, while public corporations are owned by the state of directors appointed by the government. So it is owned by the state. It is and the state is the government anyway. Then number 2, control and management. In public limited companies, owners have no control, direct control over their business management. The management is only in the hands of the management. In the hands of the managers appointed by the shareholders. While in public corporations, control and management is under government officials appointed by the board of directors. Then we have another form of distinction is under the category of raising capital or funds. Public companies invite the public to subscribe for shares through issuance of the prospectus. so for them they advertise. Yes, they can call upon the public to contribute towards share capital, but public corporations are financed by the government through public funds, that is taxes. So public corporations are owned by all of us because we all pay taxes. Let's talk about distribution of profits or dividends. In public companies, shares are divided among its shareholders at the end of the year as dividends, whereas in public corporations, all of us share. Whether you contributed anything or not, we all we all enjoy the fruits of the businesses owned by or under public corporations. Why? Because the profits are shared in the form of government providing essential services like hospitals and roads. Purpose of companies are profit making, while public corporations, their purpose is provision of goods and services at reduced prices, just to favor that common person who can't pay expensively. Then formation, public companies are incorporated by registration through the Company Act, whereas public corporations are formed under the Parliamentary Act, are formed by the Act of Parliament. Yeah. So maybe let us briefly talk about the capital structure of companies. This is the type of capital. So the type of joint stock companies is called the capital of joint stock companies is called share capital. So we shall in future ask you what is a share. A share is a unit of capital. Yes. This is because it is raised after selling shares. That capital is called the share capital because it is raised after selling shares. Let's talk about the different types of capital in joint stock companies. How are they called? Authorized capital. Sometimes they call it nominal capital. Sometimes they call it registered capital. This is the maximum amount of money that the company is allowed for business operations and expects to raise by selling its shares to the public. It's stated in the memorandum of association. Thus, if a company wishes to sell maybe 150,000 shares of 10 shillings each, its nominal share